World Development Report 2014. Risk and Opportunity. Improving Financial Access, Strengthening Financial Stability, with Thorsten Beck, Professor of Banking and Finance, Cass Business School.
What do people, households, enterprises use financial services for? It's a wide variety of purposes. Households, enterprises use payment services to transfer money, to relate to the formal market economy. They use savings and credit services to smooth consumption, to buy durable goods such as fridges, such as TV sets, such as cars. They use saving services for retirement purposes, insurance products to insure against shocks in their life. Funeral insurance policies, for example, are very popular in certain parts of the world. Similarly, entrepreneurs need financial services to finance working capital, to finance the fixed assets investment. Now, by using these financial services, people don't just benefit themselves. Ultimately, it also helps society as such. It helps share prosperity. It helps ultimately reduce poverty on the individual levels, but also on the aggregate levels. Now, if we look at financial diaries, which try to document the financial life of poor people, we see that actually even the poor are financially very, very active. They use a variety of providers, a variety of products, mostly informal. The challenge is, why are these people not using formal financial services? And the underlying assumption is, informal financial services, yes, they are often easily available, but they also have certain shortcomings. They might be more costly, they might not be available when you most need them, and they often invade the privacy of people. So why is it that we observe this wide variation in the use of formal financial services across the world, especially the scarcity of formal financial services in the developing world, and even within developing countries, that some people have very easy access, other people have barely access? And I would like to focus on the one hand on more structural factors, on the other hand on more institutional or policy factors. On the structural side is the issue of scale. Poor people, micro-entrepreneurs have demand for small transactions, small payments, small amounts of savings, small insurance policies, small credits. And given that providing these credits, savings, payments has a certain fixed cost element to it, it makes providing these services very costly for formal financial institutions. It often makes it commercially inviable. The second major structural factor is the riskiness of large parts of the population in many developing countries. There's the informality. The people don't have formal IDs, for example. They don't have a formal workplace. Maybe the entrepreneur does not have a formal title to the land on which his enterprise stands. And this shuts them out of the formal financial system, even of getting such a simple thing as a bank account. Similarly, having very volatile income, not having a formal job, but depending on income and revenue as it comes in, again, makes them unlikely customers of formal financial institutions that rely on frequent payments, on repeated income, on certainty. And again, it shuts them out from the formal financial system, both from the side of the formal financial institutions, but even from the demand side. Many of these people feel, banks, that's not for us, that's for the other ones. How can we overcome these barriers? And I think financial innovation is critical here. Just to give a couple of examples. Mobile banking, the use of mobile phones to make payments, but even to save, or even now to get a credit, has become more and more popular. And of course, the big advantage is that the costs of using a mobile phone is much lower for the financial institutions than having a brick and mortar branch. So they are able to reach out to a much larger part of the population, especially taking into account that in many countries, more people have a phone than have a bank account. Similarly, using shops, using a gas station to provide financial services instead of a proper brick and mortar branch is much cheaper, as it again helps to reduce the cost. Let me give a second example, rainfall insurance. The insurance of farmers, of agricultural production, has been always tricky because you need to actually verify whether the insurance claim is a valid one, which is very costly, again, given the size of these claims. Now, having rainfall insurance, which is more objective because it orients itself at meteorological data, not on the individual case, but on general meteorological data for a specific region, again, makes the provision of these insurance policies much more cost effective. Third example, entrepreneurs who cannot provide formal collateral, who do not have formal financial accounts, can be screened with what is called psychometric screening methods, which looks more at the entrepreneurial capacity and drive, and giving loans based on that kind of analysis rather than of the past, meaning the assets she has accumulated or the financial accounts of the past, is again more promising for small informal micro-entrepreneurs. How do we get this innovation? Why is it that we have more of this financial innovation in some countries but not in others? I think competition is really key here. Competition within the financial system, but maybe outside the financial system as well. So new providers entering the financial system, such as telecom companies providing payment services over mobile phones. It's also about the regulatory approach. It's about turning around the sequence of legislation, regulation, innovation, which is a very long process, and at the end of which the innovation might be already too old. Having a more open approach of trying out new innovative forms of delivering financial services and fine-tuning the regulation as it goes along is a more promising approach for these economies to actually benefit from financial innovation in the form of higher financial inclusion and more financial deepening. What is the role of government? I already mentioned regulation, competition. Of course, we cannot forget these more standard, traditional roles of the government in providing macroeconomic stability, trying to improve the court system, the collateral registries, the credit registries. However, there is maybe more of a role, a positive role for the government in bringing together the private and the public sector. For example, subsidizing certain fixed costs of providing financial services. Not subsidizing interest rate, which distorts incentives, but providing the underlying infrastructure. Providing joint platforms for financial service providers who then compete on products. Maybe also plans programs such as credit guarantee programs, which kind of subsidize certain risk elements, and again, in a cost-effective, in a balanced way. Now, we've talked about supply-side constraints. There are also important demand-side constraints which refer to financial literacy, to the ability of poor people of managing their finances, but maybe also constraints that are within the household of poor people. And I think there we've learned a lot over the last years. Now, as much as we care about financial inclusion, as we care about financial deepening, we also care about the sustainability of these policies, of this expansion. We care about financial stability. And as much as expanding financial services can bring benefits, over-expansion can bring very high costs. On the individual level, with over-indebtedness. On the aggregate level, with failed banking systems, with large crises that cost governments money and ultimately have results in social programs being cut back in order to pay for bank failures. So policies that avoid over-expansion, excessive risk-taking of financial institutions are as important as policies to enhance financial inclusion. And there are certain trade-offs when we talk about competition, for example. As I mentioned earlier, we want competition for more financial innovation that helps to enhance financial inclusion and financial deepening. The same competition, if there are too many players, can lead to cutthroat fights for market share, for excessive risk-taking, again, with high costs, both for the users and for the same financial institution. So this is a very tricky trade-off, and it requires a regulatory framework which ultimately forces banks to internalize the costs that their failure would imply for other financial institutions, for the real economy, for the users. Setting incentives right for financial institutions when they take the risk is a very critical element. Taking into account that financial institutions interact with each other, interdepend of each other, and that there might be certain cycles of overexpansion, and trying to address them through what is now called macroprudential regulation are very important policies. And again, we have to understand that some of the policies that try to expand financial inclusion can have unintended consequences. We've seen it here in the US, but also in Europe, where programs to expand housing credits have led to over-indebtedness and ultimately to banking crisis. So it is a very tricky trade-off and a topic that where we are still learning to fine-tune the balance between financial inclusion deepening on the other side and sustainability and stability of the financial system on the other side.